Good morning, everyone. Well, actually, good afternoon. Well, we're getting there, depending on what time zone you are. Um, Thank you for joining us today. We're excited to share some timely insights that can help make sense of the evolving financial landscape. I'm going to begin in a few minutes to talk about the One Big Beautiful Bill, as it's called, or the acronym OBBB, whatever's easiest to roll off your tongue. We're going to look at key tax provisions, what this means for individuals and businesses, and how it may shape really the broader economic economy in years ahead. From there, I'm going to hand it off to Chelsea, who will walk us through the current market outlook, covering tariffs, the job market, inflation, and what we're seeing in monetary policy. And she'll also highlight both risks and opportunities, which should we all be mindful right now. And then Cynthia is going to close us out by talking about emerging investment trends and opportunities. She'll help share how we can position portfolios to navigate near-term challenges while pursuing long-term growth potential. So let's get started. You'll see some other screens flashing by. Um, we are required to let you know today that this is education and informational information only. Please take it and discuss this with your financial advisor or your CPA firm or legal counsel before enacting any of the ideas that we're presenting today. So we're going to kick it off with the big, beautiful bill. And it's really going to be real difficult to unpack every part of it in a short amount of time. So I'm going to really focus in on some key items here. Now, I know a lot of people thought about the big beautiful bill as something that was really, quote for the rich, and I know that's defined kind of loosely. But I think after you'll see the provisions that we're talking about today, it's really geared towards upper middle class, and below, where a lot of the changes have been put in place. In theory, and I never understand how our government always works, but any legislation, tax legislation that's enacted has to be revenue neutral, meaning um, the government can't really profit by it, but we can't also get into a deficit based on how the tax policies are formulated. So you're going to see a lot of things put in place. Some of it might make sense, some of it is not as intuitive. I think it goes towards the government's goal mandate to be, revenue neutral from a standpoint of how the tax policy is going to work. So, a couple key things. What you'll see and what's different about this legislation is that some of the rules that were enacted in the previous tax regime are going to be made permanent. Some of the rules that are enacted are retroactive, meaning they go back to the beginning of this year. So you have to be mindful of some of the decisions you make this year. And then there's going to be some new provisions that are added that are going to expire in future years if not extended or made permanent. So, a couple key things that we're going to, focus in on is the standard deductions. So you'll see across the board, and we're not going to list all the different filers, but we're going to just focus on individuals and couples. Obviously, you have married filing separately and head of households, so there's different numbers for those. But you'll see across the board that the tax provisions from the 2017 Tax and Jobs Act have been made permanent, and you'll see that the individual standard deduction has gone to 15,750, 31,500 for couples, and they're going to be indexed for inflation. Unfortunately, personal exemptions are going to still remain eliminated. The child tax credit now has been increased to $2,200 per child with future inflation adjustments. Understanding, again, some of these have income qualifications to take that. Mortgage interest has now been limited to $715,000 of home indebtedness, and home equity loan interest still remains disallowed. And then clean vehicle and energy credits are going to be eliminated after 2025. So if you're planning on making any purchases on clean vehicles or taking advantage of any energy credits, please take advantage of that in this year. Complete the purchase so that it qualifies for your 2025 return. A couple things I also want to point out that are new. On the charitable side, the bill has also introduced a deduction for non-itemizers up to $1,000 for single, $2,000 for couples, while limiting the benefit of itemized charitable deductions for higher income. So it's an either or, and so if you don't itemize, you get the benefit of taking this what they call an above the line deduction. If you itemize, this is not available. So that's I think it's really important. Another thing to keep an eye on is in 2026, for the first time, the government set a floor. Um, for charitable deductions. So think about your medical expenses. They have to exceed 7.5% of your adjusted gross income. They just introduced this new bill, and well, not it's new bill, it's law, where in 2026 your charitable deductions have to exceed 0.5% of your adjusted gross income. So simple math: if your adjusted gross income is $100,000 and you're making charitable deductions, it has to exceed $500 to start to receive any benefit if you choose to itemize. Now, keep in mind, a really important planning tip we're going to talk about is qualified charitable deductions. So these are outside of your itemized deductions, so that doesn't impact this. So what you'll find is when you're at age 70 and a half, which used to be the old rule for when you had to start your required minimum distributions, you are eligible to donate 100 up to $108,000 this year directly from your IRA to a charity. And what that does is it does not enter income, doesn't impact your AGI, doesn't get taxed at the state level, and it doesn't impact your Medicare taxes, which is a big deal. So I think that's a really important thing to keep in mind. However, just as a note, any of these qualified charitable deductions, the QCDs, cannot be directed to a donor advised foundation or a private foundation. So just keep that in mind. So one of the other planning techniques that we talk about, because this is gamemanship. I mean, what the government was trying to do was simplify tax preparation by putting in such a high standard deduction. It really eliminates people from filling out a Schedule A. I mean, that was the goal, and it really impacted. It was like a 60% reduction in the number of people that had to complete a Schedule A when the original 2017 Tax and Jobs Act went into place. So I think that's important to keep in mind. So one of the tactics you can do is what they call bunching. If you get in the habit of, putting all your qualified expenses, charitable deductions in one year, you can try to get over the standard deduction limit so that you can take advantage of that in that year. And then the following year, you wouldn't make charitable deductions and you would take advantage of the standard deduction. So the idea here is just to bunch standard deductions in years that you could exceed the standard deduction, and years that you can't, you benefit from the standard deduction. So I think that's a key point to point out here when you're looking at playing around with your Schedule A and itemized deductions. The slide that Cynthia has had up are a lot of new provisions. So these are really brand new, and some are going to be a little interesting to see how they plan out. So one of it is no tax on tips up to $25,000 per person. Now there is a phase out. That phase out begins at $150,000 for a single person and $300,000 for a joint filer. The key thing is how this is all going to get reported. This is actually retroactive, so it impacts this tax year, and the IRS in all their glory has not really made it very easy for organizations because the onus is going to fall on the businesses. The other thing to keep in mind, uh, and we don't have time to really get into today, the IRS is going to specify what industries qualify that you receive tips to work under this new legislation. Another new law that came into place is no tax on overtime up to $12,500 per taxpayer. Again, what I need to qualify is it's not the overtime pay, the base pay, it's the half time. So, the old adage, you're getting time and a half. The deduction, the tax on that is on the halftime. And again, it starts to phase out. $150,000 for individuals, $300,000 for married filing jointly. So you can see there's a lot of numbers here, a lot of phase outs. But again, this is really going to help, more of what I call, middle class people trying to get back on their feet, trying to help put more money in their pockets. So another new legislation, and this is this whole idea of reinvesting in the U.S. is car loan interest deductions for U.S. assembled vehicles. Again, that's going to run 2025 through 2028, just like the overtime legislation and just like tips. So if they're not extended, they're going to phase out at the end of 2028. The key thing here is you need to talk to your dealership about the qualifications and is the vehicle meeting the thresholds of being called U.S. assembled passenger vehicles. Leases do not qualify. This is all about buying a car and then the interest deduction for that. Um, Something else is new, enhanced standard deduction for seniors 65 plus. It's $6,000 is another standard deduction on top. This is again above the line, and it'll phase out for single seniors from 75 to 175,000. Married filing jointly, that deduction phases out from 150,000 to 250,000. Another modification from previous legislation. So, in the 2017 Jobs Act, the government created a real big uproar when they capped um, your your property taxes, your state and local taxes are all capped at $10,000. And the biggest uproar were really, think about where property taxes are at its greatest, on the east and west coast. So the government came in and created a modification to this. So they'll allow you to deduct up to $40,000, and this is going to run from 2025 to 2029. But there is a phase out after from 500,000 to 600,000 of adjusted gross income. That deduction phases out. You still get the floor, the 10,000, but you won't be able to deduct anything above 10,000 if your AGI is over 600,000. So these are all new rules. Again, this is all with the goal of trying to put more money into the middle class, because you can see, most people that are considered super wealthy or uber wealthy, they're not going to benefit from any of this. This is all going to get phased out. But again, these are temporary breaks that are going to hopefully provide near-term relief. But I think you have to take advantage of the planning before they sunset. A couple of things I want to mention before we move on to the next slide, just from a planning standpoint. Um, so in 2026, for anyone who makes over $145,000 in income, you have this catch-up provision. So right now, you can put up to $23,500 into your 401k plan. They allow a catch-up of $7,500. If you're the age of 60, 63, so you have to be 60, 61, 62, 63, and you have to finish the year out at 63, you'll receive an extra catch up instead of 7,500, 11,250. So in 2025, you can still put that into a pre-tax or your traditional, what they call traditional 401k plan. And starting in 2026, if your wages are over 145,000, that catch-up portion has to go into the Roth portion of the 401k plan. So you need to keep that in mind when you're thinking about planning next year. As financial advisors, and my dad always used to say, you always have to pay yourself first. So taking advantage of your traditional 401k plan or your Roth 401k plan are really critical. Another planning thought that you always have to keep in mind is because we always get the question, should I do the Roth? Should I do the traditional? And it's really a tax question about where you're at today from a standpoint of what your marginal income tax bracket is and what it will be when you think you're going to take money out in retirement. And I know we don't have a crystal ball. Tax rates could be higher, tax rates could be lower, they can be right where they are. As advisors, we have to kind of work with what we know today. So the rule that we utilize within our firm is if you're in a lower tax bracket today, 10, 15, maybe even 20%, you're probably better off putting money into a Roth because the tax break you're receiving today is not that great. And then the ability to take that money out when it comes out in retirement, it will not be taxed. And if you're in a higher bracket or even the same bracket, you're going to be better off. And I'll explain that's the same bracket in a second. However, if you're in a high bracket today, for example, 36, 37%, and that's not even factoring, the additional taxes for Obamacare, which could put you as high as 43%. If you're in that high tax bracket, most likely well, there's a higher probability you'll be in a lower bracket. So if you're paying tax, let's say total 40%, and in retirement, you're in a 30% bracket, when you start taking your money out, you're paying 10% less in tax. So I think, the advice we always give to our clients and people we're talking to is look at the bracket you're in today. What are you paying in a marginal bracket? And what do you think your marginal bracket is on the exit side? Because at the end of the day, um, a uh, a Roth is much easier to work with in retirement. It's also a better asset to inherit because both the IRA and the Roth have to be depleted in 10 years by the inheritors, unless you're a spouse. Okay, I'm thinking in this situation, children, they have to take the money out in 10 years. The thing to keep in mind is if people live to their normal age and then their children, they're probably going to be in their higher incoming years. And if they inherit a traditional IRA, they could be paying, even higher taxes. So one of the planning ideas that we talk about, and we're not going to have time to get into today, is having parents really take some of their IRA money, convert it at their bracket in retirement if it's going to be lower than what their kids might be, paying when they inherit the money. And again, that's a more detailed analysis. But again, these are planning opportunities, for individuals to look at. The next slide that we're going to get into is estate planning and wealth transfer. So the bill made permanent the estate and gift tax exemption. So right now, next year it's going to move up to 15 million per person. So basically, 30 million and below from a taxable estate will be exempt from estate taxes, which is at 40%. Anyone above that is going to pay tax, 40 cents on the dollar for any dollar over that limit. So there's advanced planning. Again, we won't have time to get into that we work with clients to make sure that if they are over that limit, we're finding ways to bring them underneath that limit. And then again, another planning opportunity is you don't have to wait till you pass away to, gift money, or have money inherited by children or family members or charity. Sometimes it makes sense to make gifts today and use some of that exemption because you remove the value increase of that asset going forward. So a couple other gifting strategies. The gifting amounts have gone up. It's $19,000 per individual, $38,000 joint. If you're trying to help your children get started, or if your grandparents trying to make gifts to your grandchildren, you can do a super funding gift into a 529 plan, which is 95,000. And then you don't make gifts for the next 5 years. Another important planning opportunity for children who have not used up their 529 plan. Remember, they're a beneficiary of the account. The parent really controls the 529 plan. Is that if you satisfy certain requirements, you can convert up to the limit, the Roth limit, which is $7,000 this year. You can convert up to 35,000 in total. So you can take a 529 plan that is trapped in a sense for educational purposes and remove that from the 529 plan and put it into a Roth account for the child so that they can start building their investment future. Quick requirements: the 529 plan has to have been started for at least 15 years, and any contributions in the last 5 years, you have to wait like a 5 year window before they're eligible for conversion. But if you meet those two, it's a very good planning opportunity, to help children who now have hopefully out of school, didn't use all their 529 plan money and can utilize it for investment purposes. So we're going to dive into a couple quick tax breaks for businesses. So the key things we talked about are probably the majority of the key provisions that I think impact most individuals. There's a lot of other little nuances to the big beautiful bill, but the big part of the bill was to really focus on creating tax breaks, for middle class and below, so that they really would have more money to use to save or drive the economy. Because if you think about it, one of the measures you always hear about is the GDP, gross domestic product. 70% of that is made up of consumer spending. So by trying to put more money in the hands of consumers, they're hoping that that money, part of that money, is at least used to be spent on the economy. The net last area that the government really focused on was really trying to help businesses reinvest. And so they've put in some provisions here that I think are going to be pretty significant. Um, so one of them is the 100% bonus depreciation is back. So that's going to be really important. So being able to expense that right away and getting that deduction is really critical. And it's usually on tangible personal property that's under 20 years. R&D expensing has been restored. And so that's going to be so you think about it, we're incentivizing companies to spend money on research and development. It's got to be domestic, can't be offshore. And if it's domestic, again, that's going to run through 2029. Uh, Section 179 expensing, the max expensing is 1.25 million, and then it begins to get phased out. So I think those are some really key provisions. The other it's really impactful is Section 199A for qualified business income deduction. So take a step back. When the government reduced the corporation tax marginal tax bracket, um, companies that didn't really benefit from that were partnerships and S corporations. Those are called what they call pass-through entities, meaning the tax is really paid by the owners, partners of the company. So the money that's left on the income statement of a company gets passed through, and then it's taxed at the marginal rate of the individual. And so they weren't benefiting by the corporate rate. So what they came up with was this 199A qualified business income deduction. So that was made permanent and it was enhanced. It's a 20% deduction that's provided to what they call pass-through entities. So I think that's really, really critical. And again, these are all done to incentivize businesses to spend money, to reinvest. Again, it's a domestic focused legislation, and with that, it's supposed to help drive the economy. So we believe that when you take these two elements together, I think from a financial standpoint, what the government's betting on and what we see will happen is that money will start to, it's not like a light switch. We have to keep in mind whether it comes from the Fed, or it comes from the government with tax policy, federal policy, or monetary policy. It's not a light switch. It has to work through the system. So a lot of these changes that were enacted in July of this year, it's going to take 6 months, 9 months, 12 months to really start to filter into the economy. But hopefully the plan is, reinvesting in the U.S., having more disposable income to spend in the U.S. will help, support and drive the economy. So I think my part is coming to an end, and I'm going to introduce Chelsea here. She's going to take the baton from me and talk about, trends and fiscal policy. So Chelsea, I'm turning it over to you.
All right, I'm going to begin with our probably the most used T word this year, apart from Trump, which is tariffs. uh, so let's get right into it. Obviously, tariffs have been in the spotlight since President Trump's election, and you can see from this chart, the tariff rates have shifted dramatically over the past century. In the early 1900s, tariffs averaged close to about 30%, serving as the primary source of government revenue before the federal income tax became dominant. Over time, especially after World War II and the establishment of global trade frameworks like the GATT and WTO, tariff rates steadily declined. For a refresher, the GATT, that's the General Agreement on Trade and Tariffs, that was established initially as a temporary measure after World War II to try to unify some trading policies and help the global economy recover from the war. It eventually, through several rounds, became the WTO, the World Trade Organization, in 1994. By the 2000s, the US operated in a low tariff environment with average rates below 5%. With Trump's government and tariff policy, though, of course, we saw a sharp reversal of that this year. The immediate effect was that many US companies front-loaded imports ahead of those increases, and that's why we've seen unusually high inventory levels across retail, electronics, and durable goods. In the short term, this overstocking actually helps dampen price pressures as firms discounted excess inventory. But looking forward, once those inventories normalize, the higher tariffs will filter through consumer prices and business costs, likely contributing to renewed inflationary pressure in the balance of 2025. I will note we're starting to see some signs of positive impact with a little bit of the tariff revenue. We got some relatively good news last week that the federal budget, its deficit is clocking in at only 1.775 trillion, but that's down 41 billion from this time last year, and even smaller than what the Congressional Budget Office predicted just a few weeks ago. Moving into the inflation conversation, not surprisingly, as the economy digested that wave of overstocking during the summer, we began to see inflation tick a bit higher. If we look at this chart on consumer price inflation, you'll notice that the trend over the last 3 years has been steadily downward, from well above 8% in 2022 to closer to 2% by early 2025. But here's the key point. Over the last few months, the line has started to turn back up. In August, the CPI index rose 0.4% on a seasonally adjusted basis, faster than July's 0.2% increase, bringing the annual inflation rate to 2.9%. We do think consumer price inflation may have ran a little on the hot side in September, although that should diminish in October because we've had a recent drop in oil prices over the last month. Unfortunately, due to the government shutdown, the expected release of the September CPI report is delayed. I believe that's to come out on October 24th. So we'll have some more recent data, hopefully pretty soon. Core inflation, which strips out food and energy, has also edged higher, suggesting this isn't just temporary noise, but a broader shift in price momentum. Core CPI is expected to be pretty similar to the past months once reports come in, but there is still a delay there. So while tariffs didn't cause immediate inflation because of the overstock buffer, their impact is now working through the system, and this sets the stage for renewed upward pressure on consumer prices as we move into late 2025. Now we're going to shift to the labor market. In August, the labor market showed clear signs of slowing. Employers added just 22,000 jobs, already following a modest gain in July of 73,000. At the same time, the unemployment rate ticked up to 4.3%, which is the highest level it's been in 4 years, although still historically pretty low. We saw revisions to prior months. July's number was slightly revised up, but June was adjusted down to 13,000 jobs, ending what had been the longest streak of continuous job growth since the COVID recovery. A key concern has been the concentration of job gains. Nearly all the growth came from healthcare and social assistance, which added about 46,800 jobs. That means that other industries combined actually lost around 24,800 jobs, signaling broad weakness outside of healthcare. I think it will be interesting to see and observe over the next few years how or if AI begins to impact any of this. But looking at employer behavior, most firms are in a freeze to hire and freeze to fire mode. It seems many companies are pausing on new hiring right now, and this is likely due to policy uncertainty and some concerns about the impact of tariffs, especially for those small and mid-sized companies. At the same time, employers appear to be holding on to their current workers, remembering the high replacement costs and hiring challenges of those COVID years. Another factor to watch is labor supply. foreign-born workers played a critical role in rebuilding the labor force after the pandemic, easing wage and inflation pressures. But that trend is reversing with tighter immigration policies, detentions, and deportations increasing. The foreign-born share of workers of the labor force fell to 19.1% in June, and that's down from 19.8% in March. That's a decline of about 1 million workers. So what does this all mean? Both job openings and the labor supply are coming down. If they decline in balance, the unemployment rate may gradually tick a little bit higher, but it's likely to still remain under 5%, which is still considered full employment for our economy. This won't be the booming labor market with abundant opportunities that we've seen in recent years, but it does suggest a labor market that remains relatively healthy and stable, even though it's slower moving. Now let's shift to fiscal and monetary policy. The modest acceleration of inflation in August, combined with a labor market that is cooling but still relatively strong, created a complex backdrop for policymakers. It has reignited the debate whether the Fed's dual mandate of maximum employment and price stability with inflation are if they're beginning to conflict with one another. Following the September meeting, the Fed took action. We know that they lowered the federal funds rate by 25 basis points, bringing their target range down to 4% from its previous 4.25%. This marked the first rate cut of 2025, aimed at supporting the labor market that is showing early signs of softening, even as inflation remains somewhat elevated. In its statement, the Fed acknowledged the tension directly. They noted that while inflation has eased considerably from those 2022 highs, it's still above its 2% target. At the same time, they flagged that the downside risks to employment are beginning to rise. In his press conference, Jerome Powell described the situation as challenging and emphasized that policy is not on a preset course, which I think is important. Instead, each decision will be made meeting by meeting, guided by incoming data. It will be interesting to see how the data may catch up in light of this government shutdown. The Fed's updated projections suggest that we could see 2 more quarter point cuts before year end, signaling a shift toward a more supportive stance. Then that leads us all to the investment implications of this. With rate cuts ahead and changing growth inflation balance, how should portfolios be positioned? With that, I'm going to hand it over to our Director of Investment Operations and leader of our investment committee, Cynthia, who's going to walk us through the market outlook under this evolving Fed policy path and highlight where we see some of the most compelling investment opportunities.
Well, thank you, Chelsea. That is a really good overview of how tariff, inflation, and the Fed policy response are shaping today's economic environment. And we've just heard that the landscape is shifting. With higher tariffs are fitting into the cost, inflation has started to creep back up, and the Fed is adjusting its stance to balance those pressures with a slowing down labor market. Against this backdrop, the key question really is, where are the opportunities and how do we position the portfolios to manage both the near-term market risk and the long-term growth potential? And that is what we're going to focus on next, the emerging investment trend and strategies that align with this evolving environment and how we stay both resilient and forward-looking. Following Chelsea's discussion of the Fed rate policy, let's review how the stock market performed during the past rate cut cycles. Historically, the beginning of the Federal Reserve rate cut cycle has often presented meaningful opportunities for stock investors. Now that we've passed the 1-year anniversary of the first rate cut in this cycle on September 18, 2024, it's a good time to take a look at how equities has historically performed in the second year following a Fed pivot. The record is very encouraging. Over the past 50 years, most first and second year returns following the rate cuts have been positive. On average, the S&P 500 gained 9.6% in the first year, with a median of 16.4%. Now, this cycle that we just experienced in the past year has actually exceeded these averages, delivering a return of more than 17% since last September's half-point rate cut. Looking into year number 2, history suggests even stronger outcomes with an average and median return of 16.4% and 14.4% respectively. While those numbers are very impressive, and expectations may need to be tempered this time given today's elevated stock valuation. And that said, the investors should also note that not every cycle delivers gains. Equity market faltered during the 1980-1981 double-dip recession, the 2001 tech bubble downturn, and the 2007-2008 financial crisis. In each of those cases, recessionary pressures overwhelmed the tailwind of monetary easing. In other words, if the stock are to rise in the upcoming year, the continued economic growth will need to be a prerequisite. We do believe that is the case, that the growth remain intact, supported by a more stable interest rate, fiscal stimulus, resilient consumer demand, ongoing productivity gains, strong artificial intelligence investment, and the likelihood of additional rate cut down the road. But perhaps what is the most important is the corporate earning. That will be the more decisive factor, as the history shows that sustained equity gains ultimately depends on the ability of companies to deliver profit growth. That's where we're going to turn next, an in-depth look at the corporate earnings and their role in shaping the market opportunities ahead. Corporate earnings are remaining at the foundation of the long-term stock performance, even when that headlines more driving the short-term market swings. While the valuation appears elevated relative to history, they are supported by the company's ability to consistently deliver earnings growth. In the second quarter of 2025, 81% of the S&P 500 companies beat analyst estimate. That is the strongest beat rate since 2023. And that resilience shows how businesses are adapting to higher cost, tariffs, and the policy uncertainties while still finding growth opportunities. Looking across the sectors on this chart, with the tech lead on the far left with a 91% beat rate, which is pretty much driven by the demand for AI and digital infrastructure. Financials and healthcare follows with 88% and 85%, while the industrials and real estate also held up strongly. In contrast, utilities and energies were more of a mixed, and only half of the materials companies managed to beat expectation, reflecting more of cost pressures and a weaker commodity demand. Well, it is very important to remember that markets are forward-looking. Investors' expectations are often priced in even before the earnings are announced. When companies deliver results that exceed those expectations, it typically provides a fresh momentum for the market. And conversely, even though the earnings announcement might be still strong, it could create volatility if they fall short of the high bar investors have set. It is very similar to an A+ student that bring home A-. It is still very excellent grade, but the initial reaction as parent is likely a disappointment because our expectations were just way too high. Well, this dynamic between the earnings expectation and the market reaction is very critical It reminds us that while the fundamentals are still very supportive, volatility can still emerge when the reality and expectations diverge. Now let's take a look at how volatility fit into the equation. Market volatility on this page, measured by the WIX index, is often called the fair gauge. The WIX tracks the expected stock market volatility based on the S&P 500 options. In a simple term, it reflects how uncertain or nervous the investors are about the near-term market outlook. When we have a lower rating below 15, that signals confidence and stability. A moderate rating between 15 and 25 suggests a more cautious environment, with investors pricing in some potential bumps down the road, and a higher rating above 30 tend to coincide with a stress event when fears really drive investors looking for protection. Now, looking at this chart, the volatility spiked dramatically in April and May 2025, peaking above 52. This was driven by the investors' concerns about tariff, inflation momentum, and the Fed policy uncertainty. Since then, WIX have mean reverted, meaning that it's falling steadily back into the mid-teens. Today, it sits at 7 to 18, which is right in the moderate, what we call a more normal zone, suggesting the market have calmed after that spring turbulence that we experienced. Now, this behavior is very typical of the WIX. Unlike the stock prices, it doesn't compound upward over time. Instead, it is mean reverting, with spikes proven much more temporary, followed by a drift back towards its long-term average. And historically, that long-term average has been around 19 to 20 since the WIX was created in 1990s. That is a very helpful benchmark. With the recent rating hover around 17, 18, slightly below its long-term historical average, that means that the market currently appears calm, but they may also be more vulnerable to unexpected surprises or shocks. In the context of this chart, we can see that both dynamics very clearly. An extreme fear drove the spike earlier in this year, and now a more steady normalization. And for investors, the takeaway is that volatility will always come and go, and those spikes often present opportunities. Well, on the other hand, when we have a lower rating, it may be a sign to stay vigilant. Now let's bring the short-term volatility and the long-term allocation together by looking at the global performance trend and the case for diversification. Now this chart is very busy. We're looking at the annual return for a range of different asset classes across a 15-year time frame. It has everything from the stocks to bond, to commodities, and cash. On the far left of the chart, we show both the annualized return and the annualized volatility over the last 15 years for each asset class. Cutting through the middle of the chart in the white box connected by the black line is a hypothetical diversified portfolio composed by different weight of those asset classes. On the far right, as we look at the year-to-date performance through the end of August 2025, one of the most striking takeaways is that the outperformance of foreign stocks, both the developed and emerging market, comparing to the US stocks. The developed market rose by 23.3%, and the emerging market followed closely at 19.6%. That is nearly double the return of the US large cap stocks during the same time frame. This performance isn't just happening in a vacuum. The tailwind like the weakening dollars, global fiscal stimulus, and improving earning forecast have all helped propel those market upwards. While the US rally continued to be driven largely by the technology sectors, international equity growth is coming from a very different set of industries. In particular, the aerospace, defense, and banking have been leading contributors to returns abroad. These provide a very compelling reason to include foreign stocks in the portfolio, not just for geographic diversification, but for sector diversification as well. You're gaining exposures to areas of the global economy that the US market may not fully represent. Now, when we look at the 15-year chart as a whole, another theme really emerged is the randomness of the leadership. Asset class rotate consistently. What is on top of 1 year can fall to the bottom the next year. No single asset class maintains dominance, which makes the market timing a nearly impossible strategy to execute well over the long run. In contrast, a diversified asset allocation strategy represented by the white box in this chart tends to hover in the middle of the performance ranking year after year. It doesn't chase extreme highs or suffer extreme lows. Instead, provide a more stable returns and a controlled volatility over time. That consistency is a key for the success of long-term investors. And finally, look at how cash has performed over the past 15 years, which is represented by the dark purple box on this chart. The diversified allocation strategy has significantly outperformed cash, reinforcing the core principle of staying invested even during volatile periods is generally much more rewarding than sitting on the sideline. So as we've seen that the market has been unpredictable in the short term, but diversification and discipline bring the consistency over time. With that perspective, let's highlight a few key takeaways from today's discussion. First, the One Big Beautiful Bill has created important new tax and estate planning opportunity. We do encourage you to review those with your CPA, estate attorney, and with us to identify the best strategy for your family. Secondly, the Fed pivot has historically been a powerful tailwind for the market, and this cycle is proving no different so far. And the strong corporate earnings continue to provide support even in the face of the policy and inflation concerns. Third, the volatility is a normal part of investing. Historically, staying invested and discipline have helped investors navigate periods of market stress. And finally, diversification works by spreading across geographies, sectors, asset classes. Investors achieve a more consistent and less volatile result. In fact, 2025 has highlighted the value of Go Global, with foreign equities leading the growth by the sectors beyond the US technologies. So with that, we conclude today's presentation, and let's open for any questions.
Yeah, don't be bashful. Gives everyone a chance to stump us.
Yep.
Let's see. If you don't hear anything, we can bring up a couple current things going on.
Yeah, it doesn't seem we have any questions coming in.
Well, I think we can comment on a couple things. Right now we have the government shutdown, and I think that's, got some people concerned. We just passed, I think, our 22nd day, or on our 22nd day, which just passed President Clinton's shutdown back in 2025. The longest was 35 days, which was December 18th through 2019. It's obviously disruptive, especially if you're a government worker receiving government services or anything like that. So, the inconvenience is real. From an economic standpoint, the government is closing in on tying business right now. His impact on GDP from a spending standpoint, 68% is still personal. 18% is, as of last year was business, and 17% was government. So I think a very prolonged, uh, in excess of 35 days could start to be a little bit disruptive. But at this point, I think the strength of the business and consumer spending is keeping the GDP where it's at. But again, the massive inconvenience and just the optic of the government shutdown is problematic for people. We have two questions in the box here. Hold on. I don't know if I can see it or um, see as you plan for retirement in the next 90 days. Wow, ramping down pretty quick. What is the best steps to plan holistically? Okay, well, I'll give Chelsea that one since I was just talking about the shutdown.
Um, well, meeting with your advisor is key. You need to get a good handle on your cash flow, on your tax situation. It's hard without knowing a person's situation specifically, but there's a lot of moving parts in retirement, and most people tend to retire just the one time. So you want to make sure that you're as prepared as possible heading into that year. And it'll be important, I think, when you retire, in partnership with an advisor, you need to be in conversation often. Usually and speaking for Frank and Cynthia too, but when our clients retire, it's very hands-on for those first few years, because there can be just so many moving parts, so many things to plan for. Things can shift. You might find that, all right, I'm ready to retire, but my spouse is previously wasn't ready, and now they are because I'm done. And so there's a few pieces there. So it's hard to give something more exact than that, other than it's not just looking at all right, I'm going to shift everything to bonds and live off the interest. That method of retirement is long since passed. It's not just looking at your investments, but the entire piece, and making sure things like your estate planning is buttoned up. You've got a good handle on your taxes, protection planning is lined up, things like that.
And depending on your age too, are you retiring, for your Social Security benefits, Social Security planning? Are you going to be activating that? So there's definitely planning, there with, Medicare and all that. So there's a specialist that we recommend to our clients if you're, going to be activating your Social Security benefits and Medicare. You really want to do that in advance of claiming those benefits. So. Another thing I'll bring up, and then I'll have Cynthia add into this because I know we're bringing up questions that we're getting from clients. So hopefully you'll find some value in it. Right now, first of all, rising tides raises all boats. So you're seeing the market highly, elevated right now, which is good. I mean, everyone is happy looking at their statements at the end of every month. After we got out of the trough, when stocks and bonds really did very poorly in 2022, we've recovered out of that, and now we're moving into this area that's been really driven by technology and artificial intelligence. So, it's really created a high valuation, in fact, overvaluation. We call it being frothy in the market. And the challenge is it going to continue, or are we going to have a pullback? So let's do the easy part. We're always going to have a pullback. At some point, the market resets and then continues on. And if you look at historically, the market's very predictable over long periods of time, but short term it could be definitely volatile. I think we're on the precipice of a change in how companies and industries are going to start to look at new technology. Obviously, in the rearview mirror, things look easy. So think about, none of us were around where the Industrial Revolution came about, but things were done very differently before steam engines and gasoline engines and all that mechanization of our economy started to take hold and permeate. No one really foresaw, I think, the changes that happen, when the internet really kind of started coming into its own in the 1990s. I mean, I was around for that. I think most people here have been around for that. And so, think about how we conduct ourselves today, from just TV viewing and streaming to our phones to access to information, how the internet has changed business and communication. I mean, if it wasn't for the internet, we have an Amazon, right? So no one could have predicted that when Amazon started out as a bookstore that was done out of a garage. So now we're, at this AI, and AI's been worked on behind the scenes prior till last year or the year before, when it was really starting to gain some press. But that the reality is, AI is going to be here to stay. It's going to impact our lives in ways that we probably can't even imagine. But I always joke with people, if you want to ever get an idea of how it could, look at the movies. I mean, think about when Star Trek came out and all the devices that people thought, well, that's never going to happen. And a lot of those devices are in place today. There's a number of movies that use, basically AI and robots and things that we thought were unimaginable or just science fiction that are going to become reality. So I think it's going to impact our lives, and it's going to impact daily living, from how businesses interact and how business conduct themselves. What does that mean short term with the markets, though, being where they're at? The challenge is this. Right now, the market is betting and companies are betting that AI is going to have a major short-term impact. If that happens, I think you won't really see much of a pullback in the marketplace. However, if AI doesn't deliver as fast and as quickly as it's being perceived, we could see a pullback. All right. What does that mean? It could be 5, 10, it could be 20% pullback if these perceptions of AI and its usage aren't coming to fruition, because everything's forward telling. That's how the market's looking at it. So I think that's the biggest question we're getting right now. It's obviously an unknown. I'm using, past events, the industrial age, and, the internet, all these things and how they've impacted our country and the economy in the world. It's hard to see AI not having a major impact. The question is how major, and right now the markets are seeing that it's going to be the rage. It's going to be, everything's going to be moving AI. It's going to touch every business in some aspect. And again, if that really holds true, we think the valuations will get supported more strongly. If not, in the short term, if things start falling short, especially these tech companies that are betting heavily on AI, then you're going to see some constriction. And think about, when you look at your equity sleeve in your portfolio, it's the tech companies. Think about the best analogy I can give you, and hopefully it doesn't turn out this way, but think about the tech bubble that happened in 2001, right? All these tech companies were doing great, and all of a sudden there was a massive, and there was accounting and other issues that kind of happened, similar to kind of what happened with the Great Recession in 2009 and 10. But the fact is, those tech companies overvalued the overall equity sleeve of your investments, and when they pulled back, the values dropped tremendously. So right now, what you're having is, even though you're looking at equities as a total, what's really driving that aspect of the equities is the tech companies, especially those companies that are either directly or indirectly affiliated with the development of AI. So I'm gonna have Cynthia comment a little bit more if there's other things she wants to add, but I think that's the other $64 million question that we're getting asked right now, given where the market's at.
Yeah, I want to add a little bit to the first question our audience asked about get ready to retire in the next 90 days. It's usually when you are in the saving mode, where you're working, you bring home paycheck and you save a portion of your paycheck to your investment account. That is relatively an easy process, where when you have the right budget and hopefully that your advisor are providing you the right investment strategy for you to generate the return you're looking for. But when you transit from the transit to the retirement age, it requires a whole lot more planning when you are in the distribution mode, where if you have a couple of different buckets, the retirement bucket, which could be your IRA, your 401k account, or you have a Roth account, which is a tax-free account. You may have a trust or an individual taxable account, which the gains are accumulated in those accounts are being taxed at capital gains. So where are you going to take your budget from the bucket that you've created and accumulated over time? It requires a lot more planning and hand-holding from that regard. And when, as Frank pointed out, when are you going to turn on your Social Security to make sure that between you and your spouse, you are really maximizing your family benefit from the Social Security that the government are offering. So again, it requires a little bit more hand-holding and planning, and we do encourage you to reach out to your advisor and go through your budget and what your ideal retirement life that you and your spouse are expecting, and walk that through with your advisors. On the investment side, short term, given we are still on the rate cut cycle, I know we touch a little bit more on the stock market side, where it's a great opportunity on the stock market. One thing we didn't touch was the fixed income market. It also provide a great tailwind on the fixed income market when we are on the rate cut cycle. And beyond that, a couple opportunities that we had discussed in the last market noise presentation that we had in April was the diversification of including alternative investment strategy in the portfolio. There are a couple strategies that we discussed there. The private debt is still in a really good shape right now. When you think about the public debt market, is those bonds that you could purchase from the market, that those public traded companies, they need finance for their expansion, they issue the bond, and that is available to the public investors. The private debt are the private companies that who would like to raise fund, but they don't have access to the public market. And usually those debt are offering at a much higher competitive rate comparing to the public bond market. And another benefit of investing in the private debt, that for some of those who are concerned about the inflation gonna take upwards, and down the road there might be uncertainty about how Fed gonna continue to cut rate, or maybe consider raise rate if inflation really got out of control. On the private debt market, most of those debt are being structured as floating rate debt, where if the market rate, the policy rate in the market raise from where we are today, at a certain point, those private debt offering gonna keep up with the market rate and offering a much better interest rate hedge that the fixed income market does not provide. And other than that, another opportunities would be considered a long short. If you do concerned about a short-term volatility would come back to the market, the long side of the investment is if you do feel bullish about the market, you want to invest in any positions, that is considered a long of a position. And the short is if you're concerning about the price of any stock position would drop, the best way of making a profit is to short that position. So there are managers out there would really do the deep dive analysis, understanding each of the portfolio companies that they want to invest into, and understand on the short term and the long term where the stock price of those companies is going to head to. For those companies, they have high conviction. They're going to long those companies. for the companies they are concerned about, maybe their growth, their earnings down the road, they could short those positions. And overall, those strategies has been worked well and could tend to outperform a long only strategy, especially during volatile market.
Okay.
That's huge for kicking off early retirement when you're concerned about the market.
Yep.
Private debt, long and short positions. Exactly.
Hey, Chelsea, do you want to add a little more to the previous attendee? They're in their 61 and they're thinking to retire early. So anything you want to add, things that they got to think about, because it's obviously before they're able to receive Medicare and all that. So I just want to think if you want to add a couple comments.
Yeah, I think planning ahead, it depends if there's HSA money, but budgeting out potential medical expenses, of course, is huge. Pre-Medicare eligibility. I would say if this is related to the next 90 days retirement piece, I think Cynthia summed it up really well. There's a lot of people that we've met with this year worry about, did I retire at a market high, or am I retiring right before things start to dip? And one thing I think we tend to really do best here is have that three-legged stool approach, where it's not just stocks, bonds, but also alternatives. I saw a comment there about Cynthia's diversification points, and I think that's huge. So she had just talked about private debt, long and short positions if the market is super volatile. So I would echo a lot of those points. It's so individualized and unique to the person that it's hard to give super broad advice, but a good
Without the
understanding.
details, yeah.
Yeah, but a good understanding of your income needs, any predictable income sources there are, whether it's pensions, if you'll be staying where you are, or if you're planning to move to an income tax free state like Florida. There's all kinds of variables to it. So carefully coordinated conversations and planning ahead with your assets, as Cynthia said, knowing where you want to pull from first, if that's your non-qualified money, which is subject to capital gains, or if you're going to pull more from the ordinary income area from your retirement assets. All of that sort of depends on what some of those needs are and what the portfolio needs to support. And you want to make sure you stress test the heck out of that portfolio, because everything could look rosy, but if you were to add, let's say, I don't know, like a long-term healthcare event or a 20% dip at the start of retirement without diversification, all of that's going to have bearing on the outcome.
Yeah.
I'm about to sneeze.
Yeah, one thing I'll add is, accumulation and distribution planning distribution planning can actually be much more challenging in retirement. But as you're accumulating wealth, developing buckets that have different tax qualities helps, because when you're in distribution planning, you can, as we talk about, turning on different faucets from the different buckets, because the idea here is to manage your marginal tax bracket. Obviously, the lower we can keep your bracket, less of your money is taxed on the exit side. So having that opportunity is important. It gets challenging when a person, all they have is, for example, qualified IRA money and Social Security. It becomes a lot more challenging to manage the marginal bracket, because everything that comes out of a traditional 401k plan that gets rolled into an IRA is going to come out as ordinary income, which is how your salary is taxed. And then you have your Social Security, and depending on your income, there's the exclusion and all that. So just be mindful. Distribution planning is really about figuring out, as Cynthia and Chelsea talked about, where do you want to take money. But a lot of that comes from your accumulation years, when you're accumulating, building those different buckets so that you have that option. So hopefully that helps. Any other questions before we sign off? We don't mind going, over time if people have questions. I mean, that's why we're here. We enjoy trying to help people. But if not, you have our contact information. You have our email. So if something wakes you up in the middle of the night in a cold sweat, feel free to send us off an email or drop us a line, and we'll definitely respond. We usually get back to everyone within about 24 hours of being contacted. So thank you for your investment of time. Hopefully you found some great takeaways. and spread the good news about what we're doing and invite other people to attend our podcasts as well as our webinars that we do twice a year. And thank you for attending and enjoy the upcoming holiday season. Thank you.